I'm talking today with Marcus Heidkotter. Hi, Marcus.
Hi, Karen.
I know you're a day trader. How do you look at charts?
Well, I like to use range bars. It's a concept that very few traders use. You see, there are three different ways to look at charts. Most traders probably use time-based charts, where you see a new bar or a candle after 5 minutes, 10 minutes, maybe even daily charts. Then more recently, more and more traders start looking at volume-based charts, like for example these 133 tick charts, where a new bar or candle is plotted after a certain amount of trades took place. So here we are taking the time element out of the market and we're just looking at volume. So during a time when the market is traded more heavily, like the first 2 hours in the morning, we see more bars, and in the overnight session there's a compressed view with fewer bars. So that's already getting better, in my opinion, than looking at time-based charts, but I like to look at volatility-based charts.
Volume and volatility, can you overlay them?
No, volatility, you basically just look, is the market moving? So every bar has exactly the same length, and only if the market breaks out of this range, then you plot another bar. So you're no longer looking at time as an element, you're no longer looking at volume, just market movement. And this is what I, as a day trader, am most interested in. Does the market move or not?
Tell me why that, market's moving all the time. Why is that so important to you?
Well, when the market moves, this is when as day traders we can make money. When the market is just moving in a range, in a very narrow range, going sideways, this is when we usually sit on the sidelines. Most traders make money when the market is going up or down. So this is why we want to see volatility, we want to see market movement, and I don't want to see my chart moving if the market is not moving.
The other side of making money when the chart moves is you can also lose money when you see that type of movement. What type of risk management strategies do you employ?
Well, I always use stop losses, and of course then I use profit targets to exit my trade. Often I attach a so-called bracket order to my trade, so as soon as I enter a trade, immediately a profit-taking order, and a stop loss is being placed. This helps me dealing with emotions.
But there are some downsides to using stop loss orders, especially in these volatile markets. You get stopped out and then the market resumes what you thought it was going to do. How do you deal with that?
Well, you never know if the market will resume, right? So therefore, if my predefined risk is hit, I'm getting out of the trade. So I'm usually choosing my stop losses that the trade has enough room to develop, but I don't let one losing trade wipe out my trading account.
Percentage stops, or do you use a price stop?
Well, I use stops based on the average daily range. So they're also volatility based. In more volatile markets, for example, if the Dow moves 200-300 points, I'm using a wider stop. And if it only moves 60 to 100 points, I'm using a narrower stop. So I'm constantly adjusting my stops based on the volatility of the market.
So it means you have to constantly watch what you're doing.
As a day trader, that's what we do, yes.
Marcus, thank you so much for talking with me.
Well, thanks for having me today.
My guest has been Marcus Heidkotter.